Welcome back to the channel. I'm Jacob Fisher, and today we're talking growth investing. This is sort of the last in a series of investing basics for different styles of investing. We talked dividend investing a few weeks ago. We talked penny stocks. We talked beating savings accounts, which was actually a while ago. And now we're just on that final kind of phase of growth investing. That thing you can do when you're young, and you can take more risks with your money than an older portfolio that you need for retirement. I mean, you're not going to see someone who's 85 just investing in a startup company like Tesla a couple of years ago, though that would have turned out well. Might not have in the first place. Let's just tap that like button and get into it. The first option for many people to make their life incredibly easy is to consider something like a growth ETF, because not only do you reap the benefits of having a portfolio that grows even more, but you don't need to worry about any of the names in there because somebody, hopefully smarter than us, you and I, is doing that for you or for us. I have a few ETFs in there. Many of these ETFs don't grow 100 to 300% like it would investing in individual stocks, unless, of course, it's the ARK ETFs that we'll get into a bit. They might be slowing down, I think. I think they have some positions that are kind of coming down recently. But anyway, most of these ETFs have an annual growth rate of 20% or more, which is really good. With growth ETFs, you also have way more drawdowns than you would with, traditional S&P 500 companies. Now, those do have drawdowns, but not as significant as some of the tech or growth ETFs. You also have slightly higher fees, not by something insane, but just slightly higher than a typical ETF. In fact, some normal ETFs have a 0% fee, which is incredible. I think that's Fidelity is one of them. You do get that high growth though, so let's get into the next point. Let's get into those examples with Vanguard first, since they have so many ETFs out there, and they're just kind of like the pioneer of ETFs. VUG is one of their growth ones. 40% of their portfolio, or ETF portfolio, whatever you want to call it, is in technology. 47%, which is, quite a bit. They have a 27.9% annual growth rate and a 0.04% expense ratio. Technology, again, makes up most of the growth ETFs that we're going to be getting into, just because of the nature of kind of tech stocks. They want to grow super quickly. They want their valuations to go up. They want, a whole lot of stuff. ARK, I'm sure everybody's heard of ARK by now, has a ton of ETFs that the average investor can get into. So let's just go over a few of them. ARK-K, or ARKK, the ARK Innovation ETF, has a 0.75% expense ratio, 36% annual return, with Tesla making up most of the fund, which, whether or not you feel about Tesla, it's growing rapidly, and that was a good selection. However, it's kind of stagnant right now. This is their flagship fund that most people think about when they think of ARK Invest. That's just, at least in my eyes. Next, we have ARK-G, which is ARK Genomic. It's the science people in the genomic revolution. The same expense ratio, 0.75%, and a 29% annual return. Well, a few companies I've heard of in the passing that are listed on the screen right now. And then I wanted to briefly touch on the new ETF from ARK, the space one, ARK-X, which people just like to use X for exploration, maybe? I don't know. Same expense ratio as the other, 0.75%. Only been around for a few months, so its performance is untested. But it's all related to space exploration and travel. So if you're into that kind of thing, then maybe you should consider it for your portfolio, or adding the ETF, maybe a little bit, or just cherry picking some names out of it. Let's do one more, because a little too hyper-focused on ARK, so we're just kind of going to ignore them for the rest of the video. Let's get into PBW with a 0.70% expense ratio. However, you're going to look at it, you're going to see that its return since inception is only 2%, which is not very good. But the 5-year return is 42%. The issue with clean energy ETFs, which, this is one of them, is that clean energy and alternative energy wasn't the most popular thing 10 years ago. You didn't want it, right? Or, well, some people wanted it, but a lot of people, it's not as big as it is now. Now we're getting way more into clean energy being a staple product for many consumers. I know I purchase wind power, and I would try to only purchase wind power. Hopefully I get some kind of solar car. I definitely did not get one of those. The top holdings for it are FSLR and a couple others. Those solar and sustainable investments are actually getting so popular that now we have banks coming out that are eyeing up the sustainable consumer. And I've gone ahead and tested one of those banks that we'll be getting into in a few weeks. Talk out a review on a new bank, which is kind of fun. They like plant a tree for every dollar you purchase. But now let's get into choosing your own investments, like in an adventure. Number 2 on the topics out of the 3 we're going to talk about is the choosing your own investment style. I'll go over my growth portfolio in this section, but I found a lot of my stocks by looking at the RSI indicator. I'll be getting into scanning in, scanning out, choosing stocks and that, because that's in a different video in the corner, but it allowed me to find companies like Pinterest, Etsy, and Roku that all hit the scanner. So I invested in them, and now I'm up about 100% or more in each of them, and I kind of need to keep buying them because they've dropped a little bit recently. Now you can use RSI to find stocks, which is what I prefer, or you can use things like trends. Let's take, for example, you noticed we're in the pandemic, I'm sure we all kind of noticed, but you notice that a lot of people are using Zoom or companies like DocuSign to sign documents or go on video chats because you can't go in person right now. So you'd think, oh, well, a bunch of people are going to probably be buying Zoom and DocuSign are just using their services, so their revenue is going to be up, their growth is going to go insane. And that's one way to consider investments as well, is just kind of looking at trends. My growth portfolio, though, let's get into that one, is made up of quite a few stocks, and I'll invest 200 to 500 into a single stock at a time. Now it's just about building up those positions until I find another stock that I want to get into, because I think I have a pretty good portfolio, a good spread going on. I'll pop up my portfolio in the Discord, so if you want to join, it's down in the link below. It's about 43 stocks, and we got Apple, Airbnb, AMD, Amazon, APHA, ARK, ATVI, AXP, BBY, Beyond Meat, CGC, Chewy, Costco, Delta Airlines, Docu, that I mentioned, Etsy, Facebook, Fiverr, ICLN, JP Morgan, Southwest, Microsoft, Netflix, Nvidia, Pinterest, PLTR, Palantir, Plug Power, PayPal, Cure, Redfin, Roku, Run or Sunrun, Shake Shack, Shopify, Space, Virgin Galactic, Spotify, Square, Tesla, Twitter, United Airlines, Vanguard Growth, VGT, and Zynga, that little mobile game company. Now, I think it's kind of important to know the tickers we're talking about. While I list all the tickers, most of the time I know the names and I know the companies behind them. And that's like how I choose to invest in stocks. It's just making sure I know about the company really, quite a bit before investing in them. I've definitely heavy focused in tech, which, is fine, but not just tech. Services or products like Apple and DocuSign. I try to include companies like space, social media, of course, like Pinterest and some of the other things. It's definitely heavily focused around tech, but not just tech products or services like Apple or DocuSign. I try to include companies like space or social media companies like Pinterest, then companies like Best Buy and Beyond Meat. While Best Buy is not the most innovative company out there, I do like going to their stores and getting tech products from them. I guess they do sell tech products, so they're definitely tech focused. But Beyond Meat, for example, if you've tried their burger, how did they get it to taste like that, right? It's so interesting how they were able to do the things that they do. And even though it's more expensive, I think overall it's more sustainable, and I'd probably buy the burger more myself if, actually they have it in every store around me, but sometimes I just want to eat pure vegetable, it doesn't matter. Would I want to buy the company is kind of my basis for being in a certain company. I like Apple products, I have an iPhone, I'm going to buy an Apple stock. I like Beyond Meat's product, I'd probably continue to buy it, or I might pick up some more now, so I'm going to buy it. Best Buy, still shop there. Maybe I don't want to invest in space. I don't like what Virgin Galactic is doing anymore, so I'm just going to sell it and be done with it and not even worry about it because I don't like the company. It's like GameStop, right? I like the company, so I'm going to invest in it. I don't have GameStop, but still. The last option is choosing companies like E-Trade or TD Ameritrade to invest aggressively for you. Both of these companies offer robotic advising. E-Trade is called Core Portfolios. It's one I use. I think I get charged a 0.3% fee. Now, sometimes they have a 0% or a 0.5% fee. And all you gotta do is choose your risk level, and maybe you want super risk, so you tell them that super risky, and they'll do that for you. I deposit, X dollars a month, and they just disperse it through the companies that they invest into. I think it's most of the time it's just mutual funds, which they manage in the first place. So, I had a few hundred a month, and it's super easy to take out money as well, because I just say I want to withdraw X dollars and I'm like, okay, that's it, sold, done, out into my account like 5 days later, because it does take a while for money to settle with stocks because of the T+2 rule, which is really kind of dumb. I don't have the most aggressive profile option, so I have stocks and bonds. Most of my companies right now, or my stock portfolios, are about 63, maybe 66, just 2/3 are into growth, while the other 33% is into dividends. Coinbase and BlockFi are part of that growth portfolio because I think crypto is just going to grow faster in general than a lot of other things. It's just my personal preference to take on this much risk, or at least 2/3 of my total investments, to take on more risk and save the other 33% for just that safer dividend stocks. It all depends on your age and how much risk you like to take on. I'm younger, I can take on more risk. I might even go 80% growth in the coming months, just because stocks are declining and it wouldn't hurt to just keep buying more and getting more potential high growth stocks. Let me know your thoughts on growth investing in the comments below, and if you are a growth investor as well, or if you just like to take it easy, invest dividends in solid companies, value companies all around. I upload videos on Monday and Friday on travel and finance. If that's something that's interesting to you, hit that little subscribe. Yeah, hit that subscribe button. Thank you so much for watching, and until next time.